Good evening, everyone. Welcome to tonight's webinar. I'm Nancy Fellinger, one of the financial planners here at Sensible Money. Tonight, Dana Anspaugh will be talking about the best retirement investments. She is the founder and CEO of this independent fee-only retirement planning and investment firm that specializes in retirement accumulation and is a nationally recognized thought leader on the subject. Dana's the author of Control Your Retirement Destiny, one of the most respected guidebooks for consumers and financial professionals alike, and it's now available as a podcast. She's currently producing How to Plan the Perfect Retirement. It's a lecture series for the Great Courses, a premier online educational resource. Filming will take place in Virginia this summer with an expected release date of early next year. I'm in Pawleys Island, South Carolina tonight, and Dana's in Scottsdale, Arizona. We also have Sensible Money team members in other states as well. And using the same technology that we're using for this webinar, we work with clients all across the country. Please feel free as we go to add any questions to the chat box. We'll have plenty of time at the end for all of them. We'll be recording this webinar and we'll follow up with a link to it within the next several days, along with a copy of tonight's presentation. You know that retirement is the biggest financial decision you will make or have already made in your lifetime. Within that biggest decision are many smaller but consequential decisions to be made, including those around investments. Dana and our whole team here at Sensible Money live, breathe, and walk that reality with our clients every day. So let's turn it over to Dana now and get started.
Awesome. Thank you, Nancy. I do see someone asked, will we be covering the latest stock market issues? And that is a certainty. And so one of the things I want to do a little differently tonight is start off and ask you what's on your mind. I have a lot of things that I want to go through, but I want to be a little more flexible with everything that's been in the news. You know, we don't see these kinds of bear markets very often. I've been practicing since 1995, so I've certainly seen my fair share of them. And I want to share with you the perspective and what I've been through and what we've been through with clients. But I'd like to hear what's on your mind. So yes, we will be covering the stock market issues, but is there any other pressing questions before we get started? And if there's something, go ahead and type it in now. And as we go through the material tonight, I want to make sure that we cover that. And even if we needed to go off script a little bit, I really want to make sure that we get to know what's on your mind. And so, Nancy, are you seeing anything come in?
Nothing as yet, Dana. Nope.
Okay. You guys, you got nothing on your mind out there? I'm sure you'll think of stuff as we get going.
Here's one, Dana. It's more a comment. It's a long overdue correction. Everything will be fine in a few years. Here's one. What's a good allocation for retirees?
Awesome. Those are great questions, great comments. I think throughout the material we're talking about, we'll be covering all of that along with, you know, just some perspective on the latest market. Where I want to start is how we typically invest. And most of us gather this collection of stuff. And it might be a workplace plan, an IRA, employee stock purchase plan, money that we inherited, money that we started saving. We see people that have money all over the place: Fidelity, Schwab, Vanguard, TIAA-CREF, T. Rowe Price. And sometimes as they get to retirement, it's kind of a mess. And what we really need is a plan, something that looks organized. At some point, all of those things that you have to work together, and they have to be coordinated to deliver a specific outcome, which is retirement cash flow that can and will last throughout your retirement years. And so we're going to be looking at how the best retirement investments, if there is such a thing, we'll cover that, how they fit into that framework. So how do you put all of these things together to get an organized plan? Where I want to start, I used to call it the two most important questions. I'm adding a third question right now to things that you always want to ask. So with the recent market downturn, the first question I think you should ask is, when do I need to use this money? And some people are retiring next year. Some people are already retired. And the instant reaction might be right now or next year. But really that you don't need to use all of that money next year. You only need to use a portion of it. And so the real key is the portion of it that you do need to use in the near term. Where is it coming from? And so once you're pretty clear on when you need to use the money, the next two questions are can I lose any money? So if it is money you need to use next year, just for that piece of it that you would have to use in the near term, can I lose any money? And you want the answer to that question to be no. So if you entered into this market downturn at 100% stocks, as long as you don't need to use the money anytime in the next few years, you can wait it out. You don't need to lock in a loss that's on paper by selling right now and causing that loss to materialize. What matters is what those stocks or growth funds are worth when you sell them at the point in time that you sell them. If you are developing a retirement plan, the first thing that's very clear is to portion out when you need to use your money and from which account you need to use it from. And we'll be looking at that. The next question I like is, can I lose all my money? And of course, we always want the answer to that question to be no. I think of charting these on a risk scale, with risk level 5 being an individual stock. GE, we've seen taken quite a tumble last year. Individual stocks can lose a substantial amount of value in a short period of time. But when we shift that level down to an index fund, yes, we see index funds go through bear markets like we're in right now, where they are down 20% or more from a high, in some cases 30% or more. We'll look at some even more extreme cases than that tonight. But can you lose all your money? Well, if all of the companies in the underlying index went under at once, theoretically, yes. But the likelihood of that happening, and if it did happen, we've got much bigger problems on our hands. And so the real question is, what do I think this index fund or this growth fund might be worth a year from now or 2 years from now? And in almost every case, if we were to fast forward and if we didn't have access to 24/7 news on social media and if we didn't open our statements, most of the time we would never know that these things happened. And so we cause ourselves a lot of the anxiety by focusing on it, when in fact, what we really need to focus on is, where are things going to be a year from now, 2 years from now, at the point in time where I would actually need to sell some of this and use it. And so I want to take all of this and put it into a framework of looking at the underlying building blocks of investments. And generally there's three. I mean, of course, there's more, but most investments can be categorized into these three buckets: safety, income, or growth. And if you think of them plotting on this triangle, as I move toward an investment that's going to have income, by nature, I have to give up some safety and I have to give up the potential for growth. If I want to move toward an investment that has the opportunity for growth, for higher returns, then it's not going to be as safe and it's not going to produce as much cash flow. And if I want safety, well, that means I'm, again, giving up growth or income. And right now, and for quite a long time now, the price of safety has been very low returns. And as we see interest rates go back down again, it's going to remain that way. So the price of keeping your money safe means that you're going to earn a really low interest rate. And there's just no way around that in this environment. What we want to focus on is that question around, how do you build a retirement allocation, is how do you build this portfolio mix? And so I want to look at each corner of this. And first, I want to kind of plot, where do different investments fall? And you're seeing a few things pop up here on the screen, and I'm going to get a few more to pop up and then talk a little bit about where these things fall. So safety, you've got things like savings accounts, certificates of deposit, fixed annuities, agency bonds. Growth, you have small cap stocks, dividend paying stocks, raw land. You have, of course, large cap stocks, growth mutual funds that own stocks. All of those fall in the growth category. With growth, we're expecting that over time, we're going to have capital appreciation. With safety, we're not expecting capital appreciation. We're just expecting that we're going to preserve our money. And then on the income category, you have things like corporate bonds, immediate annuities. And then you have some things here that get plotted between these two. So dividend paying stocks, for example, would fall a little bit more toward the growth corner. But since they do pay dividends, there's also an income component to them. Rental real estate, a little bit more toward the income corner, But because you would expect that underlying real estate to appreciate, to have capital appreciation over time, it's got a little bit of a growth aspect to it. So there are things that get plotted with a little bit of a hybrid quality to them. Normally, I start talking about the safety corner first, but tonight I want to focus on growth because that's what the markets are talking about. That's what everybody is focused on. And what I want to do is go back and look at some previous market declines, very similar to the one that we're experiencing right now. So I don't know if you've ever heard the saying that you can't see the forest for the trees, but I have a friend that took that saying a little farther, and he used to say, yeah, and you can't see the trees because you got bark in your teeth. And so I had come up with this display, this example called Bark Trees Forest. And so right now when the media goes a little crazy, it's kind of like we get bark in our teeth, right? We get so caught up in everything that everyone runs out of toilet paper. Those are the things that happen when we have bark in our teeth, right? We have a toilet paper shortage. In the markets, here's what that looks like. You may have seen the headlines today talking about this was the biggest single decline since 1987. In 1987, there was a day called Black Monday, and in a 5-day period, the market was down 28%. And that's this black dot to this black dot. And it's pretty scary when that happens. If we step back and get that bark out of our teeth and start looking at the trees, well, the 5-year annualized return, even if you invested the day before that market downturn, so you invested right at this top black dot, the 5-year annualized return was 6.7%. Still a very decent return. This is S&P 500 that we're looking at here. Now, the question we often get is, shouldn't I sell? I want to miss out. Well, we're already down. So if you could be 100% confident that you could sell and get back in at a lower price, that could potentially work to your benefit. But I will tell you, in 25 years, I've never seen anyone successful at it. And I'll have people say to me sometimes, well, I wish I would have been smart enough to ... There are incredibly smart people that came out of the best schools. They trade for hedge funds, they trade for banks, they trade for big corporations, and they can't successfully call these things and make these kinds of timing decisions. So no one should beat themselves up and say, I wish I would have been smart enough. It has nothing to do with that. It has to do with luck. So every once in a while, someone happens to get out of the market and they're able to buy back in at the bottom. Yes, those luck stories do happen. I personally, in my years of practice since 1995, haven't seen it. And so I have seen people get out and then they get so scared that they sit on the sidelines and they get back in, oftentimes after they miss the first 10, 15, sometimes even 20% of the recovery. And so they took something that could have been a temporary loss in 1987. By 1989, you would have recovered and actually made money. And they take that and they turn it into a permanent loss. And so that's what we get concerned about when these downturns happen. If you take this same situation and now we step back and we look at the forest, here we see the 10-year annualized return. If you had been lucky enough to put all your money in at the bottom, was 11.6%. If you invested right at the top of the black dot, you still earn 9.8%. Both are very attractive returns. Sticking with that long-term plan this is why we encourage that. We know that the odds of making a timing call right, that has statistically a much higher chance of actually hurting your long-term wealth than it does to just stick with the investment plan. And I'm going to show you some real life examples because I have gotten to see this firsthand with clients too. This isn't all theoretical. Lived through it, breathed through it, been through this before. But I want to walk through one more example. This was the most recent bear market we've seen, other than what's happening right now, was September of 2008 through March of 2009. We had a 7-month decline, black dot to black dot, that was down 46%. And trust me, it wasn't fun and it wasn't pleasant. And I had clients that retired in December 2007, and they are fine. No one had to make any substantial changes to their lifestyle. So I can assure you that planning works. But it doesn't mean it's fun to live through these kinds of bear markets. Here was the tree view, right? So we're stepping back, getting that bark out of our teeth. 5.5 years, even if you went from the high point, the top black dot, you still had a 7.6% rate of return. That was through the end of 2013. Not a bad outcome at all. And the 10.25-year review, so September 2008 through December 18, was about 7%. And so again, still not a bad outcome. That's the S&P. When you look at real life portfolios, what does it look like? This is a snapshot of a real client's portfolio. There's index funds and bonds inside this portfolio. Of course, we always have to have our disclaimers that you cannot invest exactly in what's shown on this screen. Every client's portfolio is customized to them, and timing impacts things, and all of those standard disclosures. But it is useful to see that this was March of 2009. And so we can see, let's see if I can get a little highlighter here. We can see that when we look out 10 years later, that really had little impact on their long-term wealth, as long as they stuck with the plan. So what you're looking at here is that black line is showing the person's net investments. What did they contribute to the account? And then the blue line is showing their portfolio value. And of course, there's ups and downs and volatility. That is the nature of the market. What matters is that you're selling during these ups and not during these downs. Looking at some additional examples, this was another person that we've worked with since 2004. And again, in hindsight, this was the bear market in 2009. And again, it had no impact on their long-term wealth or their ability to retire as they planned. This funky little dip that you see here was an account that was in transfer, and so there was a few days where the software wasn't recording that particular account value. So there wasn't a case where the market actually dropped that suddenly just for those few days. It's just there was one particular account that wasn't being tracked. Then this was a client that retired in December 2007. This particular client was one where we were not successful in keeping them invested. And so as advisors, we look at success as getting through these market corrections or bear markets without a single client insisting on going to cash. And this particular client did insist on going to cash down here near the bottom. And you're going to see that their portfolio never quite recovered. And I want to contrast that with somebody who stuck with the plan, had about the same amount of money. They experienced this bear market, they stuck with the plan, and their portfolio did recover. We have these real life examples where I have seen clients that emotionally were not willing to stick with their plan and they have the worst returns. And seeing that firsthand is what gives us this confidence to say, oh my gosh, once you have a plan in place, you absolutely have to stick with it. It works. This will not have a material impact on your long-term retirement plans or your wealth unless you let it. The last example I want to walk through is somebody that retired right in December of 2007. And so this black line shooting up is their 401k plans rolling over into IRAs. And that was a scary time to retire. You watched their wealth drop down from over 2 million down to just under 1.5. And then they sold a house and had some extra cash to put back in, and then bought another house, but their portfolio did recover and has essentially maintained itself throughout retirement while they have continued to draw out all of the original cash flows that we projected that they would draw out. So those are some real life examples of what a bear market looks like in the rear view mirror, right? In hindsight, what does it look like when you're looking back on it? I know when you're in the middle of it, it doesn't always feel like that. And so when it comes to that growth corner, the key to having success there is making sure that you're not selling that growth during one of these down markets. We spent actually the last 2 days investing cash into growth because everything's on sale. We get to buy at a 30% discount. So that's a really good time to put cash to work. It doesn't mean it can't go down more. We could easily see another 10% or 15% decline. But it does mean historically, anytime we've had the opportunity to buy at 20 or 30%, discount that has proven to be a really good move when you look back a year or 2 years later. And that's what we focus on is that long-term perspective. What allows you to have that perspective is making sure that you have money in the other two corners. And so I want to talk about the income corner and about the safety corner and how you position those so that you are not concerned about the day-to-day, week-to-week, or month-to-month moves that are going to occur in the growth corner. When we look at the income corner, one of the first things I want to talk about is the real estate market. So some people buy rental real estate, and those of us, know that 2008 and 2009, actually, as we went into 2010, a lot of real estate was worth half of what it had been worth in 2005. And if you had a property rented out, you continued to get that rent, but on paper, your property value dropped substantially. And if you hung on to that property, eventually the property values would have recovered. The challenge with rental income are there can be additional expenses. And so properties need upkeep. And in the middle of a downturn, you can lose a renter because unemployment is high and the economy isn't doing good. So you have to be able to maintain that property even if it doesn't have a renter for a while. And you have to be willing to put money in to fix things, whether it be the roof or the fence line or the plumbing. There's always going to be maintenance. And the biggest mistake I see people make with real estate is they jump in with no experience and they forget to hold enough cash to cover the expenses that are going to come up, and they forget to factor in vacancy rates, that there are going to be times where the property will be vacant. It won't be 100% occupied. And so when they're calculating out the potential for return, they just often forget about those things. But for those who have experience in real estate, I have seen people quite successful at building up a portfolio of rental properties that are income producing. So definitely that falls in the income corner. Another thing we see are REITs, which are real estate investment trusts. This is where it's like a mutual fund, and that mutual fund may focus on apartment complexes across the US or medical facilities or big box stores that are leased out to places like PetSmart. And so that's a way to participate in the real estate market. They tend to pay higher dividends, but they are also, very volatile. The underlying share price can be very volatile. And then sometimes when we're in one of these environments where interest rates are really low, people start looking for these high yielding stocks, and they get desperate to have some kind of return when savings accounts are paying nothing. And you can get in trouble with that strategy too. What we're looking at here is a company called Annuity Capital Management, ticker symbol NLY. Back in 2011, it had a yield of 14 or 15%. If you were using one of those online stock screeners, you might be thinking, wow, that's amazing. If I buy 10,000 shares, I can get $6,500 quarterly dividend. Holy cow, that's unbelievable. Or at one point at the bottom of the market, $7,500 a quarter. But if you're relying on that for income, well, the yield came down, and by the end of 2015, that dividend was $3,000 a quarter, not $7,500, and the share price was also down. And so focusing just on yield is not a good long-term strategy. In market downturns, we have seen many high-yielding investments cut their dividends, significantly reduce their payouts, and when that happens, the share price goes down. And so we don't really like that as a great long-term strategy for building a retirement portfolio. I also want to talk about annuities. So where do those fit in? And we have immediate annuities that do fall in this income corner. And then we have something called a fixed annuity that works much like a certificate of deposit issued by the bank, and it falls in this safety corner. And then there's something called equity index annuities, where it is basically a fixed annuity, but it ties the rate that you earn to a stock market index. And it will have caps, and it will have a minimum return on it, and something called a participation rate. And when you add all of that together, There have been several studies that show the historical performance of an equity index annuity is much like that of a certificate of deposit. And so those also fall into the safety corner. And then you have a type of an annuity called a variable annuity. And variable annuities fall into the growth corner. They're often sold as if they are the Swiss Army knife of investment products, as if they can do everything. And really, there is no single product out there that can be great at everything. It doesn't work that way. There is no magic bullet. There's no magic potion that solves it all. And we'll talk about that in a minute. When you talk about all of this, I want to cover the annuities in a little more detail because immediate annuities are something that are income producing that can help protect the growth portion of your portfolio. With interest rates where they are, immediate annuities have a very low what's called payout rate. And so when you buy income producing annuities, the higher interest rate, the better off you're going to be. And so it is challenging with interest rates super low, but they do provide safety. They provide guaranteed income. And I think of it like this, like you have this pot of money, a cookie jar, and you hand it over to the annuity company and they hand you back your cookies. And they can, have a rate at which they can give you back your cookies. And the promise they have made to you is when that cookie jar runs empty, they will continue to give you cookies as long as you live out of their own jar. And so the value of an income annuity or immediate annuity is you cannot outlive your money, right? The insurance company will come out of their pocket and continue to pay you as long as you're alive. And so in providing a base or a floor of guaranteed income to a retirement plan, I do think these products can have a good fit. What we find is that a lot of people won't buy them because it ties up your money. But it's not an all or nothing proposition. So a portion of your money can go into something like an immediate annuity, or it can become a certain strategy that you use where by a specific age, you want to put a certain amount into this product that will guarantee a lifetime income that will help protect your later years. So one of the things I always like people to think about is how to get rid of some of the biases that they have toward financial products and just simply look at all of these products as tools and to figure out how does that tool actually fit into their situation or into their portfolio, or does it? And sometimes we approach certain products with an emotional bias rather than just kind of stepping back and saying, well, this is what it does, this is what it's good at, this is what it's not good at, and how does it fit in? So immediate annuities, what they're good at is guaranteeing income for life. Then you have variable annuities, what I framed as the Swiss Army knife, one of the most complex investments out there. I find that many of the people who sell them don't even really understand how they work, and they can often have fees as high as 4% a year. Here's the challenge. What you have to invest in inside a variable annuity are the same things you can invest in outside of a variable annuity: stocks, bonds, cash. Well, if I take a portfolio and add a 4% fee onto it, it's going to be very difficult for that portfolio to deliver good returns. And that is typically what happens inside these variable annuities that have some kind of a income rider attached to them. I cover this in the annuity chapter in my book. I use this example of Wallet 1 and Wallet 2. And so some of these variable annuities will describe things like a ratchet or a step up, a guaranteed 7% return. And what happens is there's Wallet 1, that's your real money. If you cash in the annuity, that's what you get. And then there are these formulas that they apply that make the amount of money you have appear much larger. I call this Wallet 2. But it's simply an accounting entry, and the Wallet 2 value is only used to calculate the amount of guaranteed income you can take. So what happens is the way these products are presented in a salesy way is people think that this Wallet 2 is real money, like that's what the account is worth, and it's not. It's only used in a formula that then determines this much smaller withdrawal amount that they are allowed to take out each year without jeopardizing the guarantees in the contract. So the takeaway is if you come across variable annuities, you want to examine them very carefully. You want to really understand how they work and not fall into the trap of a slick illustration that makes it appear like you have this large guaranteed dollar amount. Usually that's not real money. My view is that you buy insurance or an immediate annuity to guarantee income, and you use index funds for your growth portfolio, and there's no reason I would want to wrap a 4% fee around my growth portfolio, and that is exactly what's happening in a variable annuity. So I'm not a huge fan of those. Then on the income corner, you have bonds. And with a bond, you have your principal value, and you see that does fluctuate, this bottom line. And then you have interest that comes in, or a coupon rate. So if I was starting Dana Corporation, it might be, bond for sale. You come to me and I say, great, if you lend me, a bond is a loan. If you lend me $10,000, then I'm going to pay you 4% interest, or $400 a year. And so that interest payment goes out each and every year. But what happens, let's say it's a 10-year bond. So at the end of the 10 years, I owe you your $10,000 back. But interest rates suddenly go up. We would love to see that, wouldn't we? So let's say in this example, interest rates went up to 6%. Investors would look at you and your bond only pays 4%. And so if you had to sell that bond before it matured, they might say, you know what, right now you're only going to get about $8,500 for it, or $8,000 for it. And so bonds do fluctuate in value. And when you use bonds appropriately, though, in a retirement plan, you buy that bond and you plan on holding it to maturity. So you know exactly what you're going to get when it matures, and you know exactly what you're going to get along the way. And that provides a piece of your portfolio that is highly predictable. And used that way, we really like bonds in a portfolio. When you see some of the conflicting things in the media about it, it's because, yes, they can fluctuate in value. And if you're not going to hold them to maturity, yes, when interest rates go up, you can see that bond go down on paper. And if you own a bond mutual fund, then you don't have the option of holding those underlying bonds to maturity. This example here is from the AAII. They walk through exactly how your bonds would change. So if you have a 4% coupon bond and it had 10 years to maturity and interest rates change by 2%, so interest rates rise by 2%, you could expect that bond to go down by about 15%. And so yes, they do fluctuate in value. What really matters is that you hold them to maturity. And I'm going to move on to the safety corner. So when we think about safe investments, of course, it's something where we can't lose money, but we have to keep in mind that you actually can lose purchasing power. So depending on where inflation is at, if you parked all your money in the mattress and you took it out 10 years later, the price of gas is going to be higher, the price of a gallon of milk is going to be higher. So technically your money did lose some purchasing power. Now, safety is a great place to keep your money when you know you're going to need it soon. So savings accounts, money market accounts, treasury bills, some of the annuities that we were talking about. And the nice thing with a savings account is your principal is not going to go down in value. Your interest rate is going to fluctuate. It was at nearly zero for many years. A year ago, amazingly enough, we could earn almost 2%, and in a very short period of time, we're back down to nearly zero again on our safe money. But the good news is what that safe money does is it allows you to relax when you go through these volatile times, right? You don't have to worry that you have to sell your stocks when they're down 30% because you have that safe money that you can pull out of, and that is what's fueling your cash flows in retirement. And I'm going to talk about this concept of building basically a ladder, a bridge, a runway, whatever we want to call it, that helps you get through these market downturns by just using your safe money. And that concept is where we go when we start to put all of this together, is how do you use each of these buckets to put together a plan where what's going on in the news doesn't have to concern you, And by that, of course, with a virus going around, of course it concerns us, right? But meaning it doesn't have to concern you that this is going to have a material impact on your future lifestyle, right? You're not going to have to suddenly, I have some clients, their first question to me is, do I have to live on cat food now? And so we are always saying, no, you're not going to be in a situation where you have to live on cat food. And that's what we all want to be, right? We want to know that our situation is secure. And
Dana.
so, yeah.
Oh, sorry. Hey, before you move off of this, a question came in that I think fits right here, and that is, where would a reverse mortgage, where would that appear in this?
So a reverse mortgage, depending on how you use it, would typically fall into the income category. And so if you can either have a line of credit that you can tap into on that reverse mortgage, or you can have a consistent income stream. So when people think of a reverse mortgage, you're borrowing equity out of your house and you don't have to make any loan payments. The loan balance grows, and there's a certain ratio, as I'll often use the example, if you pass away 20 years later, yes, your loan balance is higher than when you initially took out the reverse mortgage, but your home value is also higher, and your heirs still get the net difference. So as long as your home is worth more than the mortgage, your heirs get the difference. If for some reason your home is worth less than the mortgage, the government guarantees the difference, and so they do not come after your estate or your heirs for that difference. So that's the basics behind a reverse mortgage. There are a couple ways to set them up. You can set them up so that you have guaranteed income. You have to be at least age 62. If you Google reverse mortgage calculator and put in your zip code, it'll give you some interesting stats so you can get the basics of how they work. Or you can use them periodically. So if I were going to use them periodically, I'm going to get into that when I talk about how we put all of this together. So I'll incorporate that. Thanks, Nancy, for
Okay, sure.
for me. Let's take a look at a sample. Let's assume that this person was using something we call an asset liability matching or time segmentation approach, buckets of money, you'll hear it called. But basically, it's allocating across the safety corner, the income corner, and the growth corner. And as you use this allocation, the money they have to take out the first year, let's say that was $30,000, is in this safe bucket. In the income bucket, there's bonds maturing each year, and that covers usually the next 5 to 7 years worth of cash flows. So the money they have in the equity bucket, literally, I want you to think about it as the only time you take money out is when it's overflowing, which would not be right now, right? And so there's years where it does overflow, and you go, great, I'm going to sell in those years, I'm going to replenish these other buckets. That process is what allows you to relax as you're going through these kind of market downturns, because in most cases, you would have 7 years, sometimes 10 years before you ever had to take anything out of that equity bucket. Every time we look back in history, if we look out even 1 or 2 years from the market downturn, that equity bucket has recovered. Where the reverse mortgage would fit in is either, if you were taking income from it, then you would need less cash flow every year from these buckets, or there are some advisors that recommend that strategy, that you might take nothing out of your portfolio during years where the market was down, and you might instead borrow against home equity and use that. And then in years where your equity bucket overflowed, you could repay a portion of that reverse mortgage, repay what you borrowed. So that could work with either a reverse mortgage line of credit or a regular line of credit, where you could tap some alternative source of cash so that you didn't have to pull anything out of stocks, so that your cash flow is still secure and always putting you in a position where you never have to sell your growth portfolio while it's down. When you think about this strategy in terms of our risk levels, the two most important questions you can ask about your money: can I lose all my money? If you had that safety bucket and that income bucket with bonds maturing, let's say covering 8 years worth of cash flow, then you are in this situation where you go, wow, for the next 8 years, when do I need to use my money? The part of my money that's volatile? Not for 8 years. And then you don't have to worry about those day-to-day or week-to-week moves. And literally, my orange juice analogy here, when the growth bucket overflows is when you replenish some of the bonds that you've used for cash flow purposes. So when you ask that question about the money that you need to use in the near term, can I lose any money in this safe income bucket? The answer is no. And if you're using primarily index mutual funds, not individual stocks in your growth bucket, when you ask that question of can I lose all my money, the answer is no. Again, unless we had truly an Armageddon, the world as we know it ends. You can then step back and say, all right, I have this long-term perspective here, and I don't need to panic when these market events happen. Just like here, I see a year where the equity bucket's overflowing. There are going to be years where it's going the opposite way. And we're in one of those situations, of course, right now. And we know it's not permanent. And so there's no need to do anything. A lot of times we get very emotional as if we should be doing something right now. When you have a plan in place, it's kind of like crash testing for helicopter pilots or airplane pilots, right? They have to do a lot of simulations to know what to do if an emergency comes on. And it's stick with the plan. They have a set of steps that they follow. And when you have a plan and a portfolio in place, then the steps that you follow are to let that plan work. And this kind of portfolio design buys you a ton of time to continue to have your cash flows come in and your lifestyle come in, and plenty of time to allow the equity markets to recover, because we know they're going to be volatile. The thing that always gets me are people that are surprised when volatility comes along. So statistically, we have a market correction about every 8 months. Of course, it never happens exactly like that. That would be easy, right? And a bear market on average about once every 3 or 4 years. And so it's been 11 years this time. So we know they happen. We just never know exactly when. And we don't know exactly what the trigger is going to be. In most cases, it's something that no one saw coming, right? It wasn't predictable. And that's exactly what we're seeing right now. So when you're looking at this concept of whether I want to call it an income ladder, I often think of it as a bridge, and I'll explain that in a minute. But you actually want to take it down to the individual account level. So if I were looking at this sample here of someone that had Social Security coming in, and then we needed $30,000 to come out of their non-IRA savings, like a brokerage account, and we needed that for the first 4 years, and then we needed about $30,000 a year to come out of their IRA. And this particular design of where the money came from would be based on what was most tax efficient for them. So it does not always make sense to use IRA, non-IRA money first. In many cases, it makes sense to draw money out of the IRA first. So don't think of this as a recommendation. It's all based on taxes. But in this particular sample, then not each account would be invested identically. Matter of fact, we would need at least $120,000 in safe investments out of this $200,000 in the non-IRA. And so if I look at how that would play out in this non-IRA, here's my $120,000 that's in safe investments, and that would leave me $80,000 that I could invest for growth. And then in my IRA, I would need about $188,000 to cover then the following 4 years of cash flows, leaving me about $411,000 to invest in growth. And so my IRA would have about 31% in bonds in this sample and about 69% in stocks, and my non-IRA about 60-40. The household itself would be at about 60-40. So at the beginning, someone had asked, where should their retirement allocation be? Well, it's impossible to answer for us without laying out these cash flows and knowing how close is one to retirement. So, and where does the money need to come from? Which account will be drawing out of? That is how we then determine what the allocation should be. And we start by determining it at the account level. So I think of it as a job description, right? I now have laid out the job description that this particular $200,000 has to do. And I have a different job description for this $600,000 that's in the IRA. And now I can start to align those investments up in a way that matches the job that I need them to do for me in retirement. That is a very different process than filling out a risk questionnaire and saying, I think I should have about 70% in stocks. And so that kind of risk questionnaire analysis may be fine when you're younger. I'm still not a huge fan of it. I think younger people, for me, myself, I have 100% of my money in stocks. And yes, I haven't even looked at my portfolio. But I'm not going to retire for easily 15 years. And so I want to give myself the potential for maximum growth rates. When I will start shifting my portfolio to the kind of strategy we're talking about here, where I start adding bonds in, is 10 years out from retirement. So if 10 years out from retirement, I start peeling off growth and adding, I'm going to go back to my buckets, adding, a bond that matured 10 years. And then the next year I add another bond that matures 10 years out, and then another one that matured 10 years out. By the time I got to retirement, I would have this 10-year bridge, this 10-year runway of bonds maturing every single year, so that I wouldn't have to worry if the market was down that particular year or that particular month. And so I'm a fan of investing based on your actual time frame versus a risk questionnaire or versus what's actually going on in the economy. Make a plan, and then you line up your investments to that plan. I call it a bridge. I liked this train going through the Swiss Alps, somewhere I would love to go one day, but have not yet been. Because when you have those safety and those income corners covered, literally, I think of this valley as what happens when the market goes down. But you have these safe investments to rely on to carry you through those volatile times. And that's what allows us to be talking to our clients right now, reassuring them and saying, look, your plan is solid. No, you don't have to go to cat food. You're going to be fine. You don't have to lower what you take out of your portfolio. We just stick with the plan. So in conclusion, how do you pick the best retirement investments? Well, you lay out a job description. So rather than getting caught up with what's going on in the economy, or rather than using a risk questionnaire, you literally lay out a job description that shows when are you going to retire and how much money you're going to need from which account in which year. And then you are able to line up those investments to that job description. For those of you who have done hiring in your life, imagine trying to hire someone without a job description, right? How do you know if they're a good fit? How do you know if they have the right characteristics to get that job done? And so think of a long-term plan for your portfolio, a retirement income plan, as laying out that job description so that you can then go out and go, okay, which types of choices out there best fit the job that I need my portfolio to do in the specific years that I will need it to do that. I'm going to open it up to questions here in a minute. To learn more, I definitely cover this whole strategy in my book, Control Your Retirement Destiny. I also podcasted the book, and chapter 5 is the one that covers investing, and we've gotten a lot of great feedback on it. So right now, if you're feeling nervous, or if you want to learn more about some of the things we've talked about, it's free. Podcasts are free. They're on Apple, they're on Podbean. On iTunes. And so I would encourage you specifically, if you're concerned about the markets, to go to and download the podcast that covers chapter 5 on investing. So with that, I want to open it up to questions.
Dana, there's a question about Social Security here. Will the bear market affect Social Security?
I don't believe the bear market will affect Social Security. No. No, I can't see how that would impact Social Security. So I can, address some other concerns I hear about Social Security. Will it be there? That
may be part of the question. Yeah.
Yeah. So if we go back to 1983, we actually got down to where the trust fund said that Social Security was going to run out. I think it was 3 to 4 months away from, quote, Social Security running out of money. And Congress put in a 50-year fix. And that 50-year fix involved an increase in payroll taxes, a change in the retirement age. So we're still seeing that come into effect today with those born 1960 or later having a full retirement age of 67. And so they put those changes in place to be a 50-year fix, and that 50-year fix would take you right to 2034, 2033, 2034. And so if we look at the current trustees report, that is almost exactly when it says Social Security will only be able to cover 70 to 80% of the payments. So we know that 50-year fix worked. And we know today there are also a set of small changes that wouldn't impact any one person that would provide another 50-year fix. But I don't know that the government is going to be inclined to make those changes until it's down to the wire. Hopefully it won't be like the 80s where they literally waited till about 3 or 4 months away. But it's unlikely 16 years out that there's going to be a lot of motivation to make the changes necessary. But I am of the opinion that those changes will be made. They're not going to have a huge impact on any one person. For those who are of the opinion that boom, starting in 2034, they're only going to pay out 75% of the benefits, then you can model that into your projections. So you can take your Social Security benefit projection, and then you can say, well, I'm going to assume I'm only going to get 75% of that. And if that makes you more comfortable to use those numbers in your projections, that's the way to include it in your model.
Here's something of a general question, and that is, what is a good allocation for retirees?
So in general, I don't like to see retirees lower than 50% in stocks or higher than 80. And that's a really broad allocation. And so what can sway it are whether they have outside sources of income, like a pension, how much Social Security they have, how much we have to draw out of the portfolio earlier in retirement versus later in retirement. So all of those things can swing it either toward the, comfortable with 80% in stocks or toward the, only 50% in stocks. But in general, I do like, something in that range.
Dana, how likely is it that we will slip into a recession, and how long does the typical recession last?
Where's my crystal ball, Nancy?
I
have one in the conference room. I should bring it for a prop.
That's where I last saw it.
Yeah. So
if only.
So let me, I hate predictions, right? I hate it because nobody knows. And everybody wants to sound like they know because we all want to think somebody knows. It makes us feel good, right? Do I think it's likely we would enter a recession? My personal opinion is yes. I think with the amount of travel that's being canceled, the amount of events that are being canceled, that there is a real economic impact. To put this in perspective, in December 2008, for the first time ever, collectively, the companies in the S&P 500 reported zero earnings. Do I think we're going to see that when earnings come out here at the end of this quarter? No, I don't. I don't think we're in a situation where suddenly companies are going to collectively report zero earnings. I think some industries are going to report more earnings. Netflix might be one of those, right?
Yeah,
we're all staying home, watching movies, ordering food in. I was just reading an article that alcohol sales are up, and heck, we know toilet paper sales are up. So look at Kimberly-Clark and Johnson & Johnson, and there's going to be some companies that are going to do well from this, and obviously the travel industry is being hit hard. We know our medical professionals are hard at work, and that profession is going to be in high demand. So I don't think it's every one of these situations is different, but I do think there's a chance that this will put us into recession. Yeah, I do. How long does the average recession last? I don't have that statistic off the top of my head, so I don't know.
Here's I think it's a question regarding long-term care insurance, and maybe it's along the lines of how does it fit into a plan. So the question is long-term care insurance with a question mark, particularly if you have an underlying condition like diabetes or cancer. I'm wondering if it's, would it be worth having long-term care insurance? Maybe as a form of portfolio insurance.
Yep. One, long-term care insurance, the traditional kind, does go through an underwriting process. So one of the key things to figure out would be if you can qualify for it. There are some types of life insurance policies now that maybe have a little more lenient underwriting that could give you some coverage. In general, again, it's a difficult question to answer without knowing someone's financial situation, but those who have a net worth of 2 million or more are often, and particularly if they have a home that is paid off, are often in a situation where they would be able to cover their long-term care expenses out of pocket. Vanguard has a report that shows it's about 15% of retirees that will incur long-term expenses of 250,000 or more, and then about half that will incur zero long-term care expenses. And then, of course, there's everyone else in between those two extremes. If you have a portfolio in that mid-range, your net worth is somewhere between about $500,000 and $2 million, pricing out long-term care policies can make sense. You have to see if you can qualify. You have to take a look at them. There's all different kinds out there. Sometimes you can buy policies through your workplace. So they will offer, I just was looking at one today for a client that their workplace is offering a plan to his wife that I do think she should participate in. So that could be a good place to start. And then if your assets are $500,000 or less, at a certain point, every state offers Medicaid, and they will require you to spend your net worth down, and then you would qualify for Medicaid, which is what would pick up the tab on long-term care.
The question here is Charles Schwab or Vanguard for retirement?
If you have an account at Charles Schwab, you can buy Vanguard funds or Vanguard ETFs. And same, Vanguard offers certain brokerage accounts where you can buy outside funds also. So that being said, I think it's a personal preference. We custody all of our client accounts at Schwab. I had a great experience there on the institutional side. It's different than the retail side. So some of it just depends on technology. I will tell you, in 2008, 2009, people experienced at times incredibly high call volumes with Vanguard. Not saying that's the case today, 30, 40-minute wait times. So some of it also depends on how much money you have and whether you qualify for a higher tier center call center. That's always a challenge when things get volatile like this is, can you reach somebody if you do want to talk to somebody about things?
Okay, this is a little bit long, Dana, so bear with me here. Understanding that safe investments, and that's in quotes, prevent you from selling equities at a loss, and that you have to rebalance your buckets over time. As you manage your retirement investments, how many years worth of safe investments is typical? Do you need to go out beyond, for example, 5 years or so?
So, fantastic question. Research says that if you had enough money, and most people don't, to get out to a 15-year bond ladder, then you would be insulated from even the Great Depression. Typically, we like to see about a 6 to 8 year bond ladder. With interest rates so low, sometimes we don't like bonds that have the longer maturity. So what you do is you double up on bonds that are maturing in the short term, and then when that bond matures, you have extra cash to reinvest and continue out that income ladder. But for the average person, we typically see about 6 to 8 years. It depends on how far away from retirement you are. It depends on if you're delaying Social Security, then you need a larger bond ladder on the front side of your retirement, and then a much smaller one or no bond ladder later on. So there's all kinds of factors that play into it, but my generic answer is somewhere in that 6 to 8 year range.
Okay, and going back, Dana, to the question regarding long-term care, the question is it $2 million per couple or individual?
These are those rough rules of thumb. Generally it's a couple. So a net worth of about 2 million, a paid off home. That statistic has been floating around for a few years. So with inflation, we may want to adjust it to 3 million. And those of you who have followed my work, I hate rules of thumb. So I'm throwing a lot of them out there, right? Everyone wants this. But the problem is, for every rule of thumb, I can tell you when I get down to an individual client, they rarely apply, because it depends on your specific circumstances. And that's why rules of thumbs are so tricky.
This is a great question, because this is something that we've talked about on some of our team meetings of late. Explain why it makes sense to buy any bonds other than short-term bonds now. Interest rates will undoubtedly go up and the value of the bonds will decline, especially with intermediate and long bonds.
Yep. So that's a great question. Normally, so it depends on, let's say I could get 1% more in yield by buying a longer term bond. And instead I hold my money in cash and wait. So there is a certain break-even point where it would have been better off earning that 1% from day one, even though 1% extra yield doesn't sound like much. But there is a point where it would have been better off to earn that 1% from day one than, let's say, to earn 0 or 0.5% and wait a few years. And so the investment partner that we work with, Asset Dedication, has done a lot of research and writing on that. But it doesn't always make sense to go out. And that's why I was just saying, in many cases right now with today's interest rate environment, rather than buying bonds with longer maturities, we end up doubling up on bonds that have shorter maturities for exactly the reason that you just mentioned.
Okay, and now for stock index funds, is Vanguard competitive with DFA funds?
Certainly competitive. You can Google Vanguard versus DFA and you will come across many journalists that have done the analysis. DFA only works with fee-only advisors, pension plans, institutions. There are some advantages that we think DFA has. That's why we use them. But they're not available to the retail public. And in the retail world, they are most often compared to Vanguard. When I talk about some of the advantages, when I think about an index fund, for example, if it's an S&P 500 index fund, whether it's Schwab, Vanguard, doesn't matter, and the S&P decides to, take Woolworths off the list and add Walmart or whatever exchange they're making, all the index funds have to trade on that day. They have to be exposed to the index, to the exact underlying components of it. DFA has just a different way of categorizing investments. So they are passive, like an index fund, but they will group the world of large cap stocks, small cap value, and exposure to certain asset classes like emerging markets value that's very difficult to find anywhere else. And then they will have a 6-month window. So if it was comparable to a S&P 500 fund, rather than having to trade on the same day as every other fund, they have this 6-month window where the stock could get added to the portfolio. And so there are some subtleties like that they can take advantage of better pricing through their trading process than some of the other mutual fund companies, which is why we're a huge fan of theirs. But in general, they are both passively managed approaches. Not all Vanguard funds are, but similar.
Here's a question regarding sitting on cash. So if I have a large amount I'm sitting on now, should I invest all in stocks or split 70-30 or some other amount?
So again, I don't know because I don't know when you need to use that money, right? So if it was money that I know you didn't need to use for 6 years, certainly for 10 years, boom, I would absolutely be comfortable putting it all in stocks. You might not do it all at one day. You might say, I'm going to, put 20% of it in tomorrow and then kind of take a few days. But if there was a portion of it that you're going to need to live off of here in the next few years, then I would want that portion carved out. I wouldn't expose that portion to stock market risk.
Some articles I've read say that some of your safe investments should be in immediate annuities rather than bonds. I know there are pluses and minuses here. Under what conditions should a retiree consider immediate annuities as well as how much to allocate?
So that's a great question too. For example, there's some immediate annuities that pay out over a specific time frame. So let's say 5 years. So I could put a lump sum into an annuity, and over the next 5 years, it's paying me cash flow each year. And then it's a simple rate of return analysis. Does the bond pay a higher interest rate or the annuity? Right? If the annuity pays a higher interest rate, well, you go with that. So that's one way to look at it if you're buying what's called a term certain immediate annuity. Another way to look at it would be in terms of, and this is typically how we look at it. Let's say your total spending in retirement is $100,000 a year, and between you and if you're married, your spouse, you're going to have $50,000 a year of Social Security income, and you have no pension. We would call that a 50% coverage ratio, right? So of your total annual spending, 50% of it is covered by guaranteed income sources. So generally, when we look at retirees, if less than 50% of their cash flows in retirement are covered by guaranteed income, then we may look at an immediate annuity, and we have a discussion around, do you want a higher coverage ratio is what we call it. And so that could be a reason to use an immediate annuity. I will qualify that by saying when we get into higher net worth clients, people spending 300, 400,000 a year, and we do have people like that, their coverage ratio is not going to be at 50%, right? They're not going to have that. And oftentimes they have enough assets that they fall into a different category where immediate annuities don't make sense from just a mathematical standpoint. But sometimes we still find it just brings people a certain level of comfort. They just want to know that a portion of their money is guaranteed by an insurance company, a portion of their income. So those are all factors, how you feel about it personally, how much of your cash flows are covered by guaranteed income already, and how you're using that annuity, whether it's a term certain or whether it's a lifetime income stream.
Regarding a major purchase, such as a 3-year-old used car, is it better to buy with cash or get a good loan, say when the manufacturers offer 1.9%, and let the money grow in the market?
Right now, where interest rates are so low, I'm a fan of borrowing. So I have a friend that just locked in a 30-year 2.8% mortgage rate. Unbelievable.
Oh, wow. Yeah.
I know. So when interest rates are this low, I am a fan of borrowing and leaving money to be invested.
Okay. And are bear markets a good time to do Roth conversions? And I know we've been having this conversation around the office as well.
Yes. They are a great time to do Roth conversions. And so, wonderful question. Yes, we are, a matter of fact, have been busy the last few days talking to clients, and if Roth conversions were part of their strategy. So let me explain why for people out there. So when I move money from an IRA to a Roth IRA, I can move it in kind, meaning I'm just transferring shares of an investment. I didn't actually have to sell that investment. So let's say I had in your projection that we could do $80,000 of Roth conversions this year, and that would only fill up the 22% tax bracket. And so right now, if I move that $80,000 worth of shares over to your Roth, well, I get to move a lot more shares. At $80,000, if I had done it a month ago, right, I'd still move $80,000. The dollar amount would be the same, but the shares would have been worth a lot more. And so it would have been less shares that got to move over. So when I get to move more shares over, when that market recovery happens, now that growth, that recovery has occurred in my Roth IRA in the tax-free bucket.
That's a beautiful thing, as we like to say.
It is.
Do you recommend having all of your money in one place, i.e. Schwab or Fidelity or Vanguard, etc., or would you support splitting early use funds versus later use funds, and under what circumstance?
I am a fan of as people near retirement having all their money in one place. It makes it so much easier to manage. The more accounts and the more custodians you have when you need to do beneficiary changes, address changes, investment changes, rebalancing, tax loss harvesting, when you go to file your tax return, it just makes everything more complicated. And so we have seen clients, the most extreme example I had was a client years ago. I think they had close to 30 different accounts, and we had to get that all consolidated, the amount of paperwork it took. Because when you get to retirement, you have to have a consistent paycheck. And the more places you have money and things to keep track of, and particularly when cognitive decline sets in, and it does, and it's real, it just becomes really hard to manage. So overall, I am a fan of picking your custodian and consolidating everything in one place.
And this is a question, Dana, that comes up, I think, probably every single webinar. When is the 3rd edition of your book coming out?
I love that. So, well, right now, as Nancy said, I'm under contract with a company called The Great Courses. They've been around for a long time. And so I'm producing their How to Plan the Perfect Retirement course. And so I am working on lecture 11 and lecture 12 of 12 lectures, and we'll fly out to Virginia, assuming I can travel, sometime later this year to film those. And then my plan was to then work on edition 3 of the book. The challenge is they keep changing things. And so, like, the required minimum distribution age just changed from 70 to 72. So, and there's the potential, depending on who gets elected, that tax laws could change substantially. And so, what I am concerned about is until we're in an environment where I feel like the laws might stay the same for a few years, that I will do all of this work and then instantly it will be outdated. And so right now I've kind of held back because I'm kind of waiting to see, would we have a period of time where at least the tax laws and some of the stuff stays consistent. Right now, all of the principles in my book are solid. The actual underlying tax rates have changed and the RMD age has changed, but the concepts, there's absolutely no concept in there that's outdated that isn't still true and valid today.
Mm-hmm. Speaking of RMD dates changing, so here, the question is, I heard the RMD date has changed. When it comes time, if you don't need to use those funds, what do you suggest be done with them?
So yes, it has changed. Now it's age 72 when your first required minimum distribution has started or is required to start. For us, we like that. It gives us an extra 2 years where we can potentially do Roth conversions for people. So if you don't need the money, you have a couple options. One, you can transfer shares out of your IRA in kind. So a lot of people aren't aware of that, but let's say you have your IRA and then you have a regular brokerage account and you're required to take $30,000 out of your IRA. It doesn't have to be cash. You can transfer $30,000 worth of shares of an investment, and then now it's over here in this non-IRA account, and it stays invested, and you incur no trading costs, and that can be great. You can do a qualified charitable distribution. So if you have your custodian issue the check directly payable to a charity, there can be a certain tax benefit to that. I think the maximum amount you can do is $100,000, but that portion of your IRA never shows up on your adjusted gross income, and that has a positive impact on all kinds of other formulas on your tax return that impact how much of your Social Security is taxed, your Medicare Part B premiums, how much what tax rate you pay capital gains on, whether you qualify for the healthcare tax credit. So your AGI impacts all of these other things in retirement. So having a lower AGI can help. And what am I saying? You would never qualify for the healthcare tax credit at age 72. So ignore that part of what I just rattled off. So you can charitable contribution, distribute it in kind, and those are basically your two options. You cannot convert it to a Roth. I get that question a lot. You have to take it out of the IRA, and you can only make Roth contribution if you have earned income. So you could take your required minimum distribution and then convert additional money above and beyond that to a Roth.
So Dana, along those lines, the question is, so even though you're retired, you're recommending changing to Roths? In other words, doing Roth conversions.
Yeah, so we have many people who retire, let's say around, anywhere between 55 and 70, and we are delaying Social Security, and we have several years where they're in a really low tax rate. And so we are able to get money out of that IRA at an incredibly low tax rate and get it into the Roth where now it will grow tax-free. And so, yes, when those opportunities present themselves, then we're a fan of doing Roth conversions.
And when you mention buying bonds, do you mean buying individual bonds or bond index funds?
Generally, we like individual bonds or something called bullet shares, which are a package of bonds that all mature on the same date. But that's because we're using them per that job description that I talked about. So we know exactly how much money we need to have maturing in each account. And so when that bond matures, we know what we're going to get. And so I'm not having to worry about the underlying, price, because when that bond matures, I know what I'm going to get. So for our particular strategy, we like individual bonds.
Okay, and I think, so at this point, Dana, you've answered all of the questions that were asked.
You rock, said somebody. That's awesome. Thank you. Well, you guys all rock too, for taking an evening out here to join us and hear about all of this stuff. and we really appreciate it. And I always enjoy, trying to share some common sense, and especially in the midst when there's a bunch of madness going on out there.
Yep. And actually, there is in all the among all the compliments is in retirement. Should one take out a mortgage and invest the money?
Generally, no. I'm not a huge fan of that. Although when interest rates are as low as they are right now, and it is certainly, it depends on your risk tolerance level, right? But I had someone the other day say that if they could borrow against their home equity without their spouse knowing, they would certainly be taking a home equity line and putting it all in the market right now. They just know their spouse would never go for it.
That's what I asked.
But yeah, but I understand why they would think that, right? Those of us who have studied the markets or been in this business for a long time, like, we know these buying opportunities don't come along that often. And so if I could, had a big chunk of cash that I could put in the market, and emotionally I knew it wasn't going to freak me out, and that I could kind of close my eyes and look at that cash 2 years from now, I think that in hindsight, that probably would work out very well. But for most retirees, that's too much risk. And emotionally, if it disrupts your sleep, there is a sleep factor in all of these decisions that's pretty important, right? And so we tend to look at just the numbers and the potential for returns, but don't ever forget about the sleep factor or the sleep factor of your spouse.
Yep. And speaking of sleep factor of spouse, if a husband has a 401k and a wife has her own 401k, when retiring, should you combine 401ks?
So you cannot, and that is a common question that I get, but you cannot combine retirement accounts. So required minimum distributions, for example, are based on a life expectancy table that's, individual to each of you. So your 401k could roll to an IRA and hers could roll to an IRA, but retirement accounts cannot be combined.
Okay, and I think, Dana, that may be the last question. I know you don't like to leave a single question unanswered.
I don't like to leave any unanswered questions.
So I think we're done.
Awesome.
We're good.
Well, Nancy, thank you. And
Pleasure,
everybody
as
out
always.
there.
Yep.
Yeah, thanks everybody. Have a great evening. We'll talk to you soon.
Good night.
Bye.